Okay, imagine this. You're looking at a pile of notes, maybe a textbook, some lecture slides, all about financial accounting. It can feel a bit overwhelming, right? Especially when you're just trying to get your head around the basics. How do you cut through all that noise? Well, welcome, learners. Today, that's exactly what we're aiming to do. We're going straight to the absolute core of financial understanding, the accounting equation, and the really clever system that makes it all tick. Double entry bookkeeping. This deep dive is specifically for you, our financial accounting 1 students, and we really should mention we're super grateful for the insights from your model leader, Salah Hamad, who helped shape this exploration. So our mission today is to unpack these fundamental ideas. We'll be drawing heavily from Chapter 7 and 9 of your textbook, that's Introduction to Financial Accounting, 9th edition, by Thomas and Ward. We want to show you how this accounting equation gives you a really clear snapshot of any business, and crucially, how the system of debits and credits keeps that picture perfectly balanced. Expect some, aha moments, hopefully, with examples that feel familiar here in the UK. Right, let's dig in then. Picture starting a business. Maybe a small plumbing firm, like Adam in the textbook examples. Where on earth do you start keeping track of the money coming in, the tools you buy, maybe a van, the stuff? That's where our first big idea comes into play, the accounting equation. It's not just some formula to memorize, it's like the fundamental truth, the financial DNA, really, behind all business reporting.
Yeah, that's a great way to put it. What's really quite amazing is that every single business, I mean, from a little sole trader shop in, say, a London borough, all the way up to a huge multinational company, is built on this incredibly simple but really powerful equation. It genuinely is the financial DNA. It tells you plainly what a business owns, what it owes, and then what's actually left over for the owners. It's a complete reflection of its financial position at any point in time.
So it's more than just numbers on a page. It's telling a story about the business. What is this equation, then, the one that tells us so much?
Precisely. And the core formula itself is, well, beautiful in its simplicity. Assets equal owner's capital plus liabilities. Now, this isn't just random. It's based on something called the duality concept, or dual aspect, which your textbook talks about back in Chapter 4. It basically means every single financial event, every transaction, has 2 effects, always 2. So you buy something, it might change 2 assets, or maybe an asset and a liability. The key thing is, it ensures the equation always stays in balance. Think of it like a seesaw. You can move things around, but it has to stay level.
Duality. Yeah, I remember that. Like Newton's law for money, every action has an equal and opposite reaction, keeping things balanced. Okay, let's break down those terms. What exactly are assets? What counts as an asset for an accountant?
Right. So don't just think stuff the business owns. Think of assets as the resources that fuel its future. The formal definition is something like resources controlled by the entity from which future economic benefits are expected to flow. So if Adam the plumber controls it and it's going to help him make money down the line, it's an asset.
Yeah.
Your book gives some good UK examples. The cash Adam has in the bank, maybe at Barclays or NatWest.
Okay.
His tools, obviously. Any van he uses for jobs, fixtures in his workshop, even stock, like spare parts, that's inventory. And importantly, money owed to him by customers for work he's already done. We call that trade receivables. They're all the positive claims the business has.
Right. So assets are the things the business uses to generate value. Makes sense. So then liabilities must be, well, the other side, what the business owes out. Maybe loans it took out or bills it hasn't paid yet. Is that roughly it?
You're exactly on the right lines. Liabilities are present obligations. They come from things that happened in the past, and settling them means the business will have to give up some economic benefits, usually cash. They represent claims from outside the business on its resources, claims that have to be settled before the owners get their share. So yeah, simply put, it's what the business owes, like a bank loan Adam might have taken from, say, HSBC, or amounts owed to suppliers for materials. We call those trade payables. Maybe he owes money to Screwfix for parts. These are commitments for future outflows.
Okay, got it. Assets are what it has, liabilities are what it owes. That leaves owner's capital or equity. Is that just what's left over, the remainder, when you subtract liabilities from assets? Or is it more active than that?
It's kind of both, really. The formal definition calls it the residual interest in the assets after deducting all liabilities. So yes, mathematically, it's what's left. But it represents the owner's stake in the business. There's skin in the game, you could say. It's the initial investment, plus any profits the business has made and kept, minus any money the owner has taken out drawings or any losses incurred. So while it is a residual figure, it's also a really key indicator of the owner's commitment and how the business has performed over time.
Okay, let's try and make this really concrete. Using Adam the plumber from the textbook again, worked example 7.1 says he starts his business, puts 20,000 pounds cash into a business bank account. How does that affect our equation? Assets, owner's capital plus liabilities.
Great example. So Adam's business receives 20,000 pounds cash. That cash goes into the bank account, which is an asset. So assets increase by 20,000 pounds.
Right.
And because it's Adam investing this money, his stake, the owner's capital, also goes up by 20,000 pounds. Liabilities haven't changed, they're still zero. So we have assets, 20,000 pounds, owner's capital, 20,000 pounds, plus liabilities. Perfectly balanced from day one.
Okay, that makes sense. A direct capital injection. Now, what if he then uses some of that cash, but still within the business? Example 7.2. He buys tools for 8,000 pounds cash. Does that mess up the balance? Cash goes down, I guess, but he gets tools.
But that's a perfect example of the duality concept in action. You're right, his cash at bank and asset decreases by 8,000 pounds. But he gains a new asset, tools worth 8,000 pounds.
Okay.
So one asset goes down, another goes up by the exact same amount. The total value of his assets hasn't changed, it's still 20,000 pounds. So the equation holds. Assets, tools, the 8K plus cash, 12K. Owner's capital, 20 pounds. It just shows assets changing form.
Right, so the equation always balances. It's like this constant, reliable snapshot. But we don't usually just see the equation written out like that, do we? We see proper financial reports. How does this fundamental equation show up in things like a balance sheet or an income statement?
That's exactly where the theory connects to the real-world reporting. The statement of financial position, which a lot of people still call the balance sheet, is basically the accounting equation laid out formally.
Is it really?
Yeah, pretty much. It's a snapshot on a specific date, listing all the business's assets on one side and all its liabilities and the owner's capital on the other. It literally shows that assets, owner's capital plus liabilities. It's the direct expression of our equation at that moment in time.
Okay, so the balance sheet is the equation. What about the statement of profit or loss then? The P&L, or income statement. That measures performance over a period, right? Showing if the business made money or not. Does that connect back to our equation?
It absolutely does. So the statement of profit or loss covers a period like a month or a quarter or usually a year. It lists all the revenues earned and all the expenses incurred to find out the profit or loss for that period. And that final number, the profit or the loss, feeds directly into the owner's capital part of the main accounting equation. If Adam's plumbing business makes a profit, his owner's capital increases. If it makes a loss, his owner's capital decreases. It's constantly updating the owner's stake based on performance.
So the P&L drives changes in the owner's capital on the balance sheet.
Exactly. The link is direct. Just to give you a feel, on the P&L, you might see things like sales revenue from jobs, rent for the workshop, wages, van running costs, motor expenses, electricity. On the statement of financial position, balance sheet, you'd see the longer-term stuff. Maybe land and buildings if you own them, the motor vehicle itself, inventories, stock, cash, bank balance, trade payables, money owed to suppliers, and loans.
Okay, that distinction you made, van running costs on the P&L, the van itself on the balance sheet, that brings up something important the book mentions. Capital expenditure versus revenue expenditure. Why is getting that distinction right so vital?
Oh, that's a really crucial point. And yeah, it can trip students up sometimes.
Mm-hmm.
Getting this wrong fundamentally changes where something appears in the accounts and how it affects profit. Capital expenditure is money spent to buy, create, or improve long-term assets, things the business will use for more than 1 year to generate income, not just sell on quickly.
Right.
Like Adam buying a brand new van, that's capital expenditure. It goes onto the statement of financial position as an asset. It increases the business's overall wealth.
And it's an investment in the future.
Yeah, precisely. Whereas revenue expenditure is all about the day-to-day running costs. Things needed to keep the business ticking over now, but which don't create a lasting asset. So paying the road tax for Adam's van, buying new tires for it, the fuel it uses, that's all revenue expenditure. Those costs go straight onto the statement of profit or loss for the period they relate to, and they reduce the profit for that period.
Okay, let me see if I've got this. Capital spending builds up long-term assets on the balance sheet. Revenue spending covers immediate running costs and reduces profit on the P&L. Is that the main difference?
That's the core of it, yes.
Yeah.
And you asked why it matters so much. Well, apart from just getting the numbers in the right place, misclassifying these can seriously mislead people about how well a company is doing. Your textbook mentions the WorldCom scandal in Chapter 7.4. That's a huge real-world example. They fraudulently boosted their profits massively by treating ordinary, everyday running costs like fees for leasing telephone lines as if they were capital expenditure.
So they pretended running costs were assets?
Essentially, yes. By doing that, they wrongly increased the assets on their statement of financial position and, crucially, kept those costs off their statement of profit or loss. This made their profits look way, way higher than they really were. It just shows how critical this classification is for investors, lenders, anyone relying on these statements. It fundamentally changed the story their accounts were telling.
Wow. Okay, that really drives home the importance of getting these basics right. So the accounting equation gives us the what, the snapshot. We understand the components. But how do we actually record everything? All the buying, selling, paying. How do we make sure that balance is always maintained, transaction by transaction? That must be where this double entry bookkeeping comes in, right? The how.
Exactly. We move from the what equation to the how, the recording mechanism. And double entry bookkeeping is this incredibly robust system that handles it. It's amazing to think it's been the standard for, what, over 500 years?
500 years, really?
Yeah, it's generally credited to Luca Cogafaccioli, an Italian mathematician back in 1494. The fact that the core principles he laid out are still what we use today just shows how effective it is. And the fundamental principle is that duality concept again. Every single financial transaction has two effects, equal and opposite, on at least two different accounts. Every debit entry must have a corresponding credit entry.
And we track these in those T accounts you mentioned, literally a T shape on the page to separate the two sides.
That's the traditional way to visualize it, yeah.
Yeah.
A T account represents one specific ledger account, like bank or tools or rent. The left side is the debit side, the right side is the credit side.
Okay, debit, left, credit, right. But those words, debit and credit, they often confuse people. It feels like debit should be bad and credit good, or maybe increase and decrease. Is that right?
You've hit the nail on the head. That's probably the single biggest hurdle for students starting out. Forget good, bad, or even simple increase, decrease for now. In accounting, debit just means the left side of the T account, and credit just means the right side. That's it. Where the magic happens, and how you know which side to use, is through the golden rules of double entry. These rules tell you whether a specific transaction requires a debit or a credit entry in the accounts affected.
Golden rules. Okay. Are they complicated? How many are there?
There are three main ones, and they cover different types of accounts. They really are your compass here. Chapter 9.2 in your text lays them out. 1. Debit the receiver, credit the giver. This one mainly applies to transactions involving people or other businesses' personal accounts. 2. Debit what comes in, credit what goes out. This is for things, for property, for assets, real accounts. 3. Debit expenses and losses, credit income and gains. This covers everything that affects the profit for the period nominal accounts.
Okay. Debit receiver, credit giver, debit what comes in, credit what goes out, debit expenses, credit income. Let's try applying those to Adam's plumbing business again, like in chapter 9.3, first transaction. Adam starts the business with 20,000 pounds cash into the bank. Cash comes into the bank account. So rule 2 says debit what comes in, debit bank account.
Spot on. Debit bank account, 20,000 pounds. Now, what's the credit? Who's the giver of this money to the business?
Well, Adam is. So rule 1, credit the giver, credit Adam's capital account.
Perfect. Credit capital account, 20,000 pounds. C. Debit bank, asset increases. Credit capital, owner's equity increases. Two entries, equal value, opposite sides, balance maintained.
Okay, I think I'm getting it. Next, Adam buys tools for 8,000 pounds cash. Tools come in. So rule 2, debit what comes in, debit tools account.
Yep, debit tools account, 8,000 pounds, and the credit.
Well, cash goes out of the bank. Rule 2 again, credit what goes out. So credit bank account, 8,000 pounds.
Excellent. Debit tools, asset increases. Credit bank, another asset decreases. Still balanced.
Right. What about transaction 3? Adam buys more tools, 5,000 pounds worth, but this time on credit. He hasn't paid yet. Tools still come in, so debit tools account, 5,000 pounds.
Correct. Debit tools account, 5,000 pounds. Now, the tricky bit, the credit. No cash went out. So who's the giver here, according to Rule 1?
The supplier, the person he bought the tools from but hasn't paid.
Exactly. The supplier gave the business the tools on trust. This creates a liability the business owes the supplier money. We record this liability in an account called trade payables. So applying Rule 1, we credit trade payables account 5,000 pounds.
Okay. So debit tools, asset increases, credit trade payables, liability increases, still balances.
You've got it. Now, one more. Transaction 4. Adam pays 300 pounds for workshop rent using cash from the bank. Rent is an expense. Rule 3 says debit expenses, so debit rent expense account, 300 pounds.
Yes, precisely. Debit rent expense account, 300 pounds. And the credit. Cash goes out of the bank. Rule 2. Credit what goes out. Credit bank account, 300 pounds.
Fantastic. Debit rent expense, expense increases, reducing eventual profit capital. Credit bank, asset decreases. You're playing the rules like a pro.
It seems logical when you break it down like that. What about those contra entries the book mentions, like taking cash from the bank to put in a cash till? That feels like moving money between pockets.
Contra entries are a neat little example of the system working internally.
Hmm.
Let's say Adam takes £100 cash from the bank account to put in his physical cash till, maybe for small day-to-day expenses. Think about rule 2. Debit what comes in, credit what goes out. Cash is coming into the cash till account. So you debit cash account £100,
Okay.
and cash is going out of the bank account. So your credit bank account £100 is just a transfer between two different asset accounts, bank and cash. The overall total assets don't change, and the debits equal the credits.
Right, that makes sense. So we have all these individual T accounts, bank, tools, capital, trade payables, rent, cash with their debits and credits. Where do they all live? Do they just float around?
Huh? No, they're not just floating. They are all collected together in what's called the general ledger. Think of the general ledger as the main book, the master file, containing all the individual accounts for a business.
So it's the complete collection.
Exactly. Every single asset, liability, capital, income, and expense item has its own dedicated page or account within the general ledger. And the absolute genius of the double entry system, applied consistently transaction after transaction, is that it guarantees that within that entire general ledger, the sum total of all the debit entries will always equal the sum total of all the credit entries.
Wow.
And because of that perfect balance of debits and credits across the whole ledger, it ensures that the fundamental accounting equation assets, owner's capital plus liabilities, also always remains in balance. It's the mechanism that prepares the perfectly balanced data needed for those financial statements.
That really is quite something. We've gone from the big picture, that simple, elegant balance of the accounting equation, right down to the nitty-gritty, the mechanics of how every single transaction is captured with a debit and a credit. It's a pretty genius system when you think about it, isn't it?
It absolutely is. And if you think about the bigger picture, again, getting comfortable with these fundamentals, it's not just about passing your financial accounting one exam, is it?
No, I suppose not.
You're building this mental toolkit, this framework that lets you understand the financial story of pretty much any organization you encounter. You're learning what's often called the universal language of business. It gives you the power to really see what's going on financially.
So just to recap, we saw assets, owner's capital plus liabilities is the foundation, that snapshot. And double entry bookkeeping, using those golden rules of debit and credit, is the engine working behind the scenes, keeping that equation perfectly balanced all the time, ready to be presented formally in the statement of financial position and the statement of profit or loss. Which leads to a final thought, maybe something for you to ponder. If the accounting equation must always balance, and double entry bookkeeping mathematically ensures that it does, what does it really tell us when we hear about massive financial scandals like WorldCom? It suggests the problem isn't usually the system itself, is it? It's more likely about how the rules and principles are applied or maybe misapplied, sometimes unethically. So the question for you is, how will your solid grasp of these fundamentals equip you? How will it empower you to champion transparency and integrity as you move forward into the financial world? Something to think about.
Definitely keep exploring these ideas, keep asking questions. And just remember, every transaction, no matter how small it seems, is adding another detail to a business's financial story. Understanding these core concepts is your essential first step to reading that story fluently.